While the Fed, in its release of its minutes, happened just about an hour ago, saw several policymakers open to the possibility of easing, say it may be necessary if this recovery is in fact faltering. Here now to give you a guide on how to invest off the latest policy moves, we have Larry Shover, Chief Investment Officer at SFG Alternatives. We have Mike Dueker, a former economist at the St. Louis Fed, now the Chief Economist at Russell Investments, and still with us, our guest host for today, Matt McCormick from Bahl and Gaynor. I'm going to start with you, Larry. Right. So we're hearing that perhaps members of the FOMC now are getting really concerned, or not really concerned, but concerned enough that, hey, there may be more easing in the future. The markets should like that, right? Oh, the markets will love that, but I don't think the markets believe that. I think the fact is that the FOMC is not going to do anything, and maybe a little bit more hawkish than the market wanted them to be. I mean, policy rates
today specifically.
Yes. Policy rates are zero. We have 10-year yield below 2%. What can the Fed do? I mean, the medicine becomes poison at some point. Maybe we should talk more about a pro-aggressive policy approach from Washington as opposed to printing more money. I mean, nobody has written a book on successful exit strategies from the FOMC. Nobody knows how this is going to turn out. So I do think that people are just waiting and very cautious. Well, can we even do anything more at this point, Mr. Dueker? I mean, QE3, what is that going to buy us?
Well, I think there's sort of a misperception out there that the purpose of quantitative easing isn't necessarily to drive down the long-term interest rate to its lowest possible level. The purpose of quantitative easing is really to try to take a Japan-style economic stagnation scenario off the table. And if they succeed in doing that, the 10-year Treasury rate will actually rise. And sort of my gut rule of thumb is that at a 2.25% 10-year Treasury yield, quantitative easing, it would be sort of off the table if it rises decisively above that level. And as long as the 10-year Treasury yield remains below 2.25%, that looks a little bit too much like Japan. I think that the third round of quantitative easing remains on the table as long as we remain
okay, that's a good technical way of looking at it. Matt, I mean, what do you think? If we actually see another round of quantitative easing, is that going to be enough to help grow this economy? I mean, I think a lot of people would argue that the first two rounds didn't do a whole lot.
I don't think so. If you look at the law of diminishing returns, higher highs, lower lows, they could put more money. The poison could be an issue. I look at it from this way, though. On June 30th, you have Operation Twist ending. Every time liquidity is withdrawn from the market, and I'm talking about the stock side, the market does not like it, reacts badly. Okay, and if you look at that and you look at Greece looming, it's my opinion that Bernanke is keeping his powder dry either for Europe to implode or a major bank in the U.S. to have issues, because that's, he's running out of options. He's running out of ammo. And it
seems like we're getting closer to both those scenarios.
You potentially could.
On the one hand, here in the U.S., you get Europe.
I think he's going to likely put. My question is that when you look at the owner-occupied rent, which is a big part of CPI, even though core CPI is coming in flat, as rent increases, could you have inflation concerns where Bernanke could be in a quandary where he may need to keep QE2, but rates, he could be pushed to get higher? Bottom line, I think the bond market is going to force its hand.
So inflation is worrying you.
You see owner-occupied rents, which is a big part of core CPI, starting to elevate. If you believe the BLS statistics, which I don't, right. you're going to see Bernanke is in a fix. So I think his end reaction is to speak out of both sides of his mouth, which he's not as good as Bernanke, but he is trying to do that to the market. The market is addicted to liquidity. Every time the market goes down, there's rumors of QE3 coming. People need to be cautious.
Hey, Mike Dueker, you're keying off the yield in the public markets, which, in other words, you're using the market to try to figure out what the Fed's going to do. But what about GDP? Give us your sense as you look at GDP. What's the message behind the GDP numbers? And might the Fed be looking more at those than at the market?
Right. Consider what the FOMC was looking at their meeting at the end of April. They probably had a quick look at the GDP numbers that would come out on Friday. They saw that the nominal GDP growth rate in the first quarter was only 3.7%, very low. We haven't had a rate of GDP growth, nominal GDP growth above 4.5%, which sort of would be the trend rate of growth. We haven't had a rate of growth above that since the second quarter of 2010. So how many people would have said, all right, in 2010, we're going to start another We're going to start another quantitative easing round, and then we're going to follow up on that with an Operation Twist. Who would have thought with all that stimulus that we would have all these quarters below 4.5% nominal GDP growth?
But, you know, we had
I
a guest
believe in
on,
excessive stimulus when we see it.
We had a guest on Monday, Paul Parker from Barclays, who made the point that how are you going to get a lot of GDP growth when you've got a housing situation that's still, you know, pretty much a debacle, and no one is seeing any end in sight soon. So as long as housing weighs on the economy, you're going to still have some issues with growing that GDP number. Anyway, we're going to wrap it up here. We want to thank Larry Shover. Thank you so much for being here from SFG Alternatives.